What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. Today, we're joined by my friend, Matt Faircloth, full-time investor since 2005 and founder of the DeRosa Group with a mission to transform lives through real estate. Matt's closed hundreds of millions in real estate deals and controls thousands of multifamily units. He literally wrote the book on raising private capital and is the host of the Best Ever CRE show, the longest running daily real estate investing podcast. Matt, awesome to see you. Welcome to the show.
Seth, great to be with you, man. Thank you for having me on the show today.
Absolutely. It's always a pleasure, brother. Good catching up with you before the show. But man, let's dive right in, man. For our listeners that haven't heard a lot about you, like when a stranger comes up to you on the street and they say, "What do you do?" What do you tell them?
That's such a good question, man. Like, it's like we've all been at like the dinner party or the barbecue or whatever, or even like the freaking, I mean, I got young kids, man. So my kid's soccer game and some other dad's like, "Hey, man, so what do you do for a living?" And they expect you to be like, "Oh, I'm a firefighter, I'm a teacher, I'm a whatever." It's like, shit, what do I do, man? I guess I'm a landlord, kind of, sort of. I also help people invest in real estate. But you don't want to sound like slimy when you say it. You don't want to sound like it's a pitch. So sometimes I will say I run a company that helps others invest in real estate, right? That does sound slightly slimy and pitchy. You know, like I used to do, Seth? I used to say I'm a landlord. Right? Because that always opens up conversation. Oh, landlord. Oh, that's interesting, you know? Or real estate investor. So sometimes I'll say I'm a real estate investor. Sometimes I'll say I'm a landlord. A lot of times I'll say I run a real estate investment company. That's it. You know? And people always misunderstand. No matter what you say, they're going to misunderstand you.
Yeah.
You know, like they're going to be like, "Oh, so you invest with your own money. So you're running like a family office, or you're investing with, you know, a small group or private equity or whatever." And like typically they'll ask questions which you have to correct them on, you know,
for sure.
Through conversation. People rarely change the subject if you answer that question the right way.
Yeah. Yeah, you know? For sure. I think it's like it's very intriguing for people. Like you said, most people will say, you know, a firefighter or a teacher or, you know, this or that. And then you say, "I own a real estate investing company." You're like, "Oh, yeah. All right. Well,
well, like most people in life ask you questions so that you can ask them the same question, right?"
Sure.
Like my wife likes to say, people are tuned into the radio station WIIFM. What's in it for me, right? Like, or just they want the camera back on themselves. So they're asking you what you do for a living because they think what they do is super interesting, and so they're going to. They're asking you what you do so that you say, "Well, I'm a firefighter. What do you do?" "Oh, well, I work at the ASPCA down the street and I save dogs' lives every day." Cool. And that's cool. And that's awesome. And I'm sure you do. But what we do is like, it's not something you hear very often. And you don't hear it very frequently in conversations. So people just can't help but ask, like, "Wait, so you invest in real estate? You mean like you flip houses like the people on TV?" You know, like,
I think that's where people's heads go most of the time.
All the time. They think you and I are on Flip That House. Yeah. You know, like they think that.
And what makes it more confusing is that we have flipped houses too. Because like,
I have. I know.
You know,
I did
it's
do
like,
that.
"Oh, yeah, we have done that."
Then I realized that's like, I'd rather smack my head against a brick wall than to make a career out of doing that, right? I'm flipping a house right now, and I get a little bit of agita every time I think about it, you know?
That's funny,
but
man.
I just couldn't help myself because it was a really great deal. But I've done around 4 dozen houses, and I never built a business around it. It was one of those things I was doing while I was doing other stuff. I just fell in love with landlording and the long-run residential housing game. That's what I built a company around. But yeah, most of us, if you've been around real estate investing for a while, you just can't help yourself. You see a great deal, you gotta listen. I know how to fix this. I know what this would turn into. But the market, the world thinks that that's what we do. Why do you think, Seth, there's not a TV show around landlording? There's all these TV shows around flipping houses because people think it's accessible. But like, there's so many people there's way more people that I know that are landlords, even like passive landlords that like used to live in this house, couldn't sell it, so they rented it out. And so they're just accidental landlords. There's way more of that. Why do you think there's no TV shows about landlording?
Yeah, because it's not sexy. It's boring. It's not made for TV. You're right. Like it's like when you see somebody flipping a house and you get to see, this place is a dump, and then I spent $20,000 and now look at it. It's a beautiful mansion. I just made $200,000 on this flip. That's a little bit sexier than owning a multifamily.
You collect right on the first
apartment building in Kansas City. Little.
It's funny, man. Like Liz and I and my wife when we used to do a lot more work with BiggerPockets, and we were more, in that world or whatever. I used to get like the HGTV and the A&E guys. Every here and again, we'd get pitched. And they'd be like, hey, we want you to do like the couples flip, or we want you guys to do the fix and flip where like you're wearing blindfolds or something, just something stupid, right? Just another version of Flip That House show. And we're like, hey, how about no, we don't do that. How about we do what we do now, which is landlording, right? And we never got their attention on it, probably for the reasons you just said. You're like, yeah, we're going to find somebody that wants to read off our script and, flip houses while they're both wearing matching outfits or something else stupid, like another twist on the successful Flip That House shows. But I couldn't get their attention on landlording, which I think is I think it's more interesting. Maybe you and I are the only ones who would watch. I don't know.
I guess so. Yeah, there'd be a few people. I think it would be very industry specific, though.
Yeah, I know. Right. Well, I think that's about the twist you put on it. But it's about like, if you put the whole thing about, and again, maybe I'm talking myself out of it right now, because you could put the twist of financial freedom and, long-term success and, creating good housing, like you said, transforming lives through real estate. That's all noble. But the problem with all that, and the reason why people don't want to watch any of that shit, is because it's getting rich slow. And that's not what America wants to do. America wants to, I want to watch somebody make 80 grand in 30 minutes, which, as you know, that's all BS, right? Like that's not really what they made. I've talked to people that have been on those shows, and A&E and HGTV changed the numbers. Like that's not really what they made. But America wants to believe that those things are possible, that I can watch somebody else make a lot of money in 30 minutes. Where in landlording, it's like this guy bought a single family home and he's making $300 a month. Bam! Cash flow.
Boom.
Right. Yeah.
Yeah, exactly. People that aren't in it, they'd be like, $300 a month. Like, all right, well, I guess I got to keep working. And
no, right. Yeah, I guess I got to go back to work. I can't. Right. But you watch the Flip That House show, you're like, oh man, I could do that. Yeah. I could do one of those and I could quit my job.
Right. Let's just do like one of those a year. All right, honey, let's do it. Let's go find one. Let's go do it. Let's quit our jobs.
Let's go do it.
Well, look, man, there's a lot that's happened since the last time we had an interview together. That was probably back in 2020, 2021, somewhere around then.
You still had the hair. You still had the very luxurious long hair going on, but you were in a very different world back then.
Yeah, started growing that in COVID, and I just kept it, man. Kept it going.
Is that COVID hair?
Yeah, this is COVID hair. Still here.
He's hanging on to it, right? But it looks good, man. I tried that when I was younger, and I couldn't pull it off. I just don't have enough of it.
I appreciate it. Yeah, man. Well, there's just been a lot that's changed. I mean, a lot that's changed. The real estate market slowed down. Interest rates have gone up. Are we in a housing crash? Are we not? Like so many different things. We've got different people in office that people like or don't like. There's lots of things going on, man. What are you seeing out there just generally in the last, since our heyday? I would say like 2022 is probably where it kind of peaked and then the interest rates went up. What are you seeing out there since then?
Yeah, man, those are the good old days, right?
Yeah, for sure.
Back when multifamily was cool, But I mean, it was almost like it was too good back then because it allowed a a lot of dumb money to hop in and to do dumb things and still make a lot of money doing it. And before you know it, that the dummy that got in now has a coaching program where you can pay him 15 grand to learn how to do what they did, and all that. And they're like, well, wait. How about you just got lucky, So the market allowed a lot of people to get lucky because the rates were way down. Expenses had stayed. People never talk about this, but you know what, Seth? Expenses stayed around the same from like 2018 to like 2021, 22. Insurance was around the same, real estate taxes, labor rates, all that stuff. Then in 2022, it was like, bam, expenses went way up. And during that time frame that I just mentioned, 18 to 22, rents were going up. In some markets, like 15% a year. It's like, so let's paint that equation again that I just said. Rates were down. Yeah. Revenue was taking off. Show me a market that revenue's taken off 15, like any other asset class, that revenue takes off by 15% a year, right? And expenses stay down. Well, shit, man, you got yourself a money machine. It's perfect, right? Yeah. So that was where we were, right? Then things corrected back to reality, but like that's how pendulums swing, man. They don't like the pendulum that's way on the left-hand side doesn't just magically land in the middle. It just all of a sudden goes to the right to correct itself. And then so the pendulum swung way to the right-hand side where we are today. Now, insurance has come back down a little bit, but insurance is still markedly higher than what it was a few years ago, right? Mm-hmm. We don't have to unpack why, but just a fact, y'all. That's it. Insurance is more. Let's just leave it there. Even real estate taxes, because local municipalities, all of them said, hey, wait a minute. That multifamily that we assessed at $5 million just traded for $14 million. We need our pound of flesh. So like a lot of townships across, this is yet another thing that doesn't get talked about. A lot of townships across the U.S. started doing reassessments, spot reassessments, emergency reassessments, whatever, saying, hey, all these landlords making all this money. Because that's the other thing is the media decided to paint us as the bad guys right after COVID, right? So now all of a sudden it's all about coming after the big bad landlord. And so that's the way that the townships can do it, is by jacking our real estate taxes, by reassessing, right? So that happens. Then labor rates go up. Then rents, the rent party stops. You hear like the DJ record stop in the back of the room, right? All of a sudden, markets like the cool kid markets like Austin, Phoenix, those markets start coming back down. Austin's down like 15%, in rents because of supply and demand, right? But all these things happen, and all that while all that's going on, rates go up. So we're facing a major correction. Do I think it's a crash? I don't think so. But I think that a lot of folks got caught holding the bag a bit during that correction. And there's few. My company, DeRosa's not. We're in the middle of figuring a few assets out that we bought, early in the 2020 cycle. That you buy at a 3.5% interest rate. We're not dumb enough to think that the party's going to keep going on rents and stuff like that. So we underwrote everything at 3% rent growth because it's what I've always done for 20 years. But nobody saw rates doing what they did. Not many people that I know of anyway. So yeah, I'll pause there. But we can, again, you can go where you want with that one. But that's a brief history lesson in my eyes.
Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. Totally. And just like, any kind of crazy euphoric market like that, people start getting overly optimistic. Your assumptions get pretty wild. I remember seeing, people underwriting 5, 6, 7, 8% rent growth year over year in some of these really hot markets, just because that's what it had done the previous few years. It's like, well, that's not sustainable, right? And you have that underwritten into your model for the next 7 years. It's like, well, of course those numbers are going to look good. And especially when you keep your expenses the same and you expect to refinance here in 2 years at about the same rate, or maybe a half a point higher, and instead it ends up being 4 points higher. It's no wonder that some of these deals didn't go very well.
Yeah, cap rates stay. We'll just assume rent growth stays the same. Cap rate stays down. Expenses stay down, right? You can't, like, there's so many variables in real estate investing. You can't assume that the ones that are in your favor will not change. And I think that's what a lot of underwriters did. My company, we showed expense growth. We showed minor rent growth, but we assumed that interest rates would grow, but not like they did. We thought that they would go up around a half a point to 1%, and they went up like 3% in some debt scenarios, right? So you end up in the middle of having to figure a lot of things out, Yep. So that's there. Now we're talking about those deals that were bought from 2022 to 2025, right? We stopped buying in 2022. We've only bought like off the market stuff and everything like that from 2022 to 2025. Then that begs the question, well, not everybody can just sit on the hands and wait. We got to keep growing, want to do deals, right? So where are the deals today? That's maybe what begs the question. That's probably what the listeners want to hear you and I tell them, right?
Absolutely, man. Yeah. I mean, a lot of these folks that were raising capital or buying multifamily back in the heyday, they've went back to work. They've got a W-2 job. They're back to what they were doing.
I know multiple
10
people
years
that
ago.
got out of the industry. I know
lots of folks.
This is what I know how to do, bro. I've been doing this shit for 20 years. Like, I don't know how to go back to work. I mean, I can't find my resume. I've been doing this for long enough that this
unemployable.
I'm pot committed in poker terms, right? So this is what I know how to do. I'm gonna have to figure this out. But for those that got in 2019, God bless them, because they got in when things were stupid hot, and now it's like, I get it. So for those of you that are listening, maybe you're still listening to this podcast because you didn't go back to work, let's unpack what to do now, Seth. Let's do like a so now what, right?
For sure. Yeah. So what have you done? How have you been able to stay in the game? How have you been able to pay your bills? You've built a company. How have you been able to do those things during this lull? And then what have you done now? Like, what are you acquiring? If it's not multifamily, what have you kind of pivoted to, or what are you getting into?
Yeah, I've got a trust fund from my parents. No, I'm kidding. No, that's not true. So what we decided to do, we stopped buying multi in 2022. We've done like on a mass scale. We got ourselves into off the market stuff. Like I did and this is I'll give a few little secrets that I've seen in the market, right? Number one, and we'll unpack each one of them. Off-market new builds, okay? And I'll unpack what I mean by that. And number two, debt funds for funding those that are still making things happen but need short-term bridge, okay? So we got a fund that provides those things, and that is probably our best asset today. Third thing is we got new asset classes. So take your pick. Which one do you want to unpack first?
Let's talk about the off-market new builds, man. That's interesting. I don't think anyone's talked about that.
Yeah, man. This is like, people ought to be talking about this more, right? Here's the thing. If you are a builder and got yourself into the building world, like, I know how to build things. I'm going to buy myself a plot of dirt. I'm going to build myself a multifamily that I'm either going to keep forever or I'm going to sell. That builder got into that ground because, again, unless you're using modular technology or something like that, for things that are getting done today, they likely started digging holes in the ground in 2022, 2023. That's how long it takes to build sizable multifamily projects, not 300-400 unit deals. We bought a 20 unit, and he broke ground on that thing in 2021. The world in 2021 was a very different world. And your listeners might not know this, but new construction loans are typically floating rate, just like bridge loans are, okay? So this guy got in, God bless him, to 2021, bought himself a plot of dirt, starts building a multifamily when debt was at 3.5-4% yield. What could go wrong, right? Mm-hmm. So he starts building this multifamily. Then inflation hits. And while all this is like, we're coming out of COVID, everybody's thinking like, okay, things are back to normal, right? This is good. Rates are back. The market's taken off. He thought his timing was brilliant and the whole thing. Before you know it, you know what hit the fan blades, and inflation, like the all that money we printed as a country from 2020 to 2022, time to pay the piper, inflation comes around. The Fed sees that, and so they start pumping rates, right? So his cost of lumber has gone up, and this is before the government was able to get their hands around it and say, okay, wait a minute, let's start to really, tamper these things or whatever. So before you know it, his cost of lumber probably doubled in the time that it took him to go to sleep and wake up the next morning. His lumber mill was like, hey, by the way, all your construction materials for everything you're building is now up 50-60%, right? And his labor rates were going up, all the things. So the costs went drastically up for things that were built early 2020s, right? Then his rates start to skyrocket. So before you know it, this guy's finished his multifamily building, small or big. And this is not just the guy we're talking to. This is anybody that built anything, that started, that broke ground. So your homework for your listeners, go look back through the town that you're in, the town that you're investing in, and look to see new build permits that were pulled between 2021 and 2024, guys. Okay? Whoever that is, I don't care who it is. God bless them, say a prayer for them, but they're in trouble. Okay? So call them. Right? There's your homework. I just created a lead for somebody right there. Go pull new build permits, 2021 to 2024, because their rates went up, their cost of materials went up, likely their labor rates went up. Guys, I'm one of them. I just finished a 30 unit in Trenton, New Jersey, but we underwrote for these kinds of things happening, and we broke ground in 2024. So we kind of saw these things going on. It's actually not a bad time to build now, because all those cost of materials and all those things are now baked into the equation. So when I started my new build, we used today's numbers, not yesterday's numbers. So bottom line, Seth, the deal that we bought, the 20 unit, we bought for the cost of his debt. We bought the property for what he owed on it. He walked away from his equity because listen, I just need to get out, because he had a little side note. As an attorney, you know this, but most new construction loans are personally guaranteed, right? This guy didn't want to lose his house, didn't want to lose his, nice car, didn't want to lose all that stuff. So he's like, you know what? I'd rather just let the asset go and not have the bank come back on me looking for me to have to write a check on this personal guarantee. I'll walk away from the cash I have in, is what it is. So there's more and more of those of the deals that are either just finished. So the deal that we bought, 20 unit, was 50% leased up. We bought it from, he walked away. It's like, here you go, guys, take it, finish it. We leased it up, and we're now running it as a good cash flowing asset. That's probably $1.5 million less than what he wanted to sell it for, right? We did a 36 unit we bought that in Minnesota, Red Wing, Minnesota, that the developer was halfway done, ran out of gas. And they needed help. We need cash. We're out of money. And so we came in. We brought in new, fresh equity. Developer got diluted, meaning they took a cut on their ownership in the deal. We took that cut in exchange for our GP side and our investors, and we finished the building, and now it's leased up, right? So that's what I mean by recently new builds. Your thoughts, Seth? Good idea, bad idea?
Great idea. That's incredible. And actionable items there, right? Look up new build permits from 2020 to 2024 and make the call. Just start reaching out. Just like you dial for dollars for single family or whatever it is, do the same thing for these multifamily buildings and other construction projects, and you might be able to find an incredible deal.
Yeah. And don't swing for the fences. You can swing for the fences, you guys, and try and buy 300-400 units, not for nothing. Those folks might be so far underwater that you're not going to be able to buy it from them for the number that's there. I know it's sexy to want to buy a 300 unit. I understand that. But you're going to make a lot of money on a 30, 40, 50 unit, right? Those buildings are built really, really well, and you're going to get premier rents. You're going to get, by the way, Seth, new construction underwriting, people are used to underwriting multifamily. I'm a 1970s build landlord, right? I'm used to owning a bunch of C-class. I'm over here expecting my expense to income ratio, meaning every dollar I make in rent, I got to spend 50% of it to pay my bills, my real estate taxes, my insurance, that kind of thing. For new construction, man, if you buy in the right area, you're coming in at 25, 30% of the money you make goes to pay your bills, and then you pay your debt and you put the rest in your pocket. So new construction, another little secret of the market, has a very, very low income to expense ratio if you buy right and if you buy in the right area. What really helps is tax abatements, not to get too granular, but if the local municipality is willing to help you out with real estate taxes, or at least let you grow into your new value, then you're off to the races.
Yeah. Yeah. Real quick, let's switch to debt funds. Just I want to get your take on that because those are really hot right now. We've seen a lot, like from TribeVest. I see a really broad swath of the market, and there's a lot of debt funds, and they're raising a lot of money for those things, and they're giving out cash flow immediately, which is great because some of the multifamily that is transacting right now, hard to cash flow for sure. Maybe if you can buy it, wait a few years, it's going to be a great buy perhaps. But right now, cash flow is super tight. So you're seeing debt funds, oil and gas funds, things like that to start paying cash flow today. Those things are really getting some investor capital deployed into them. What are you seeing if the market turns? Like, what are you seeing if the real estate market starts going crazy up again, kind of like 2016 and beyond? Like, what happens to these debt funds? Are they still attractive, or what happens?
It's a good question. I mean, like, I'm a student of Robert Kiyosaki's and all that, Rich Dad, Poor Dad, many, many years ago. And he talks all about cash flow, right? And I think that cash flow has become not the cool kid investment strategy for the last, 15 years. It's becoming more important now because appreciation was the game. Like the last 15 years, if you're gonna make your money in real estate, you're making money by buying a property for X and, like, no joke, in multifamily, selling it for 2 or even 3X. And that's an appreciation game. People don't realize that is a fluke, and that's not really how money in real estate's made long term. It only works because cap rates, interest rates are really, really low, right? Now that we're not in that world, I think we're in a cash flow, and like that's what's going to work. The problem is a lot of multifamily, as you said, is still going to appreciate well over time, but cash flow is going to be where real-time money is made, and time value of money is going to be a real consideration, especially with some of the uncertainty in the world. Investors are going to be more excited about me paying them a monthly check at 8, 9, 10, 11%. Versus a promise of a 15% return if everything works out right and I pay them in 3 to 4 years, right? That's kind of cash flow versus appreciation. Cash flow is a good investment strategy to use into a debt fund because you're collateralized, hopefully, with a lien on the property, personal guarantee from the borrower, and they're making you a monthly payment of whatever you negotiate. And you give your investors a cut, you keep a cut yourself. You can do it with a flat rate of return for investors that's appealing enough to them. If your investors will take 8, 9%, great. We don't structure it that way. We share the upside with our investors. So it's a really high pref plus a percentage of profit that we make in putting the money to work. So that's how we're structured. And we've grown pretty quickly. I mean, we launched our debt fund 2 years ago, and we're just crossing over 12 million in dollars at work. And yeah, I'm not yielding 15, 18, 19% like a multifamily will yield on paper. I'm yielding 8, 9, 10, sometimes 11%. Depends on the month. Depends on what we make. We just send it out the door to investors. So that's what a debt fund is. Your question about what happens if the market takes off again, I think that some debt funds will do well. Those that allow people to compound their returns will do very well because the self-directed IRA market has realized that they can achieve a multifamily yield if they just compound. They'll get to 13, 14, 15% if they compound long term. Most debt funds, if they're structured properly, can allow their investors to do that. Yeah, your cash investors that want cost segs, that want negative K1s are going to figure out you can't get that in a debt fund, which is true. I get that. There's no tax incentives. That's probably what, to your prediction, will pull people away from debt funds and from cash flow eventually is tax matters. That's what's going to pull them up into in 2026 and beyond, back over into hard assets, sticks and bricks, not paper, which is what debt is. That's just, you're just investing in a note. That's it.
Yeah, totally. I agree there. And I don't want to put you on the spot, but I'm going to do it anyways. What are you seeing? What are you seeing for the future, man? Make a prediction here. Like, I think that a lot of people want to doom and gloom, like that grabs the headlines, right? It kind of scares you, right? So you see those a lot, and then people that aren't necessarily staying up with the day to day, and they're not necessarily in the industry, they might see that and just get scared and expect like a real estate crash tomorrow. Well, people have been saying that for the last 15 years, right?
Yeah.
It's not just today. Like what now that we are in kind of a lull, right? Like transaction volume is low, especially in multifamily. What are you predicting? Are we going to crash? Are we going to go up? When's the next cycle really going to start?
It's so funny, man. I shot a YouTube video. I have a YouTube channel. You can find it, DeRosa. Just look up DeRosa Group on YouTube. And I shot a video in 2016 about whether or not the market was going to crash.
Yeah, exactly.
Right.
Exactly.
Because people were talking about it back then. Like, oh, I don't know, man. It's gotten really hot. Is it going to come back down? And I was investing in 2007, 8, 9, when like the market really, really did crash. People think that that's going to happen again. The market, history doesn't exactly repeat itself, but it kind of echoes a little bit, right? So I don't think we're looking at a 2007, 8 crash like we had back then. I think that what we're seeing now, Seth, is because the banks absolutely took it on the chin back then. Your big banks got bailed out by the government, but a lot of small banks, small community banks ended up going bankrupt or getting bought out by the big fish or whatever. So for that reason, I don't think that we're going to see a big crash. I think that banks are going to do workouts with their borrowers. They don't want to go take these assets back. So I think what we're going to see, and I think this is happening now, by the way, 2 cents. There's more workouts. There's more stuff getting sold behind the scenes. There's guys out there buying bank debt, like buying debt from banks quietly. And that's so the banks can take exits and get their money back on the street. So I think what we're going to have is while the pain works its way through while the pig works its way through the python, I think that we're going to be stagnant in real estate for a long time. I think that this is Matt's prediction. I think it's going to be this weird stagnant thing where there's no growth and the appreciation play is not going to work as well as it used to and everything like that. So I think that people, even when rates start going down, because the Fed dropped rates once, and that didn't markedly affect real estate rates. So I think that rates are going to stay around where they're at, mid to high fives kind of thing for the foreseeable future. And I think we're going to have to learn how to deal with that. And I think the pain is going to work its way out behind the scenes. And for those that want to do deals, you got to it's like Gordon Gekko. You're either on the inside or on the outside, So I think that for those that want to buy hard assets at a really, really discounted price, you got to find a way to access the banks, get the behind the scenes deals. Maybe a broker will give you a deal, but the days of making money by buying a deal that went to best and final and then best and final, best and final, I think that's far and few between. That day works when appreciation is how you're making money. So I think that I think today's the new normal, honestly, for a while. Yeah.
Yeah, well, if you think it's going to stay the same, I mean, it's difficult out there to raise capital, right? A lot of folks, they're listening to my podcast, are trying to raise capital, and it is hard.
Yes.
I've seen it across the board. I see it with TriVest. I see it with my law firm. People are struggling to raise capital. What are you seeing out there that's working? And how do we adjust to this new market?
Yeah, I think that you can't sell on appreciation right now, guys. You can't sell the dream. You got to sell on stability. Like put yourself in the passive investor's shoes, right? Any passive investor likely didn't they made a bad, if they've invested over the last couple of years, they likely made a couple of bad bets in the last couple of years on big operators or rising operators or whatever it may be. They've either had principal get lost or they've had principal that's slower to return than what they thought it was going to be, right? So you got to come at passives that are existing and looking to grow from a presentation of stability, right? A presentation of like the whole concept of a cash cow, right? Like, listen, this property makes money day one. My company, we just bought a hotel, a brand, not a, chic boutique hotel. We bought like a Hilton branded, middle of the road, peanut butter and jelly down the middle of the fairway kind of thing. Right. And it's 9% cash on cash day one. Right. Show me a multifamily that does that, by the way. So I think that if you're raising capital, you've got to sell on early stage cash flow and make sure that the deal, if you're not the operator, make sure that the operator has a plan for early stage cash flow. Maybe sell into a pref equity position instead of all this upside common equity that's going to make, all this money if the deal goes well. Well, what if the deal goes mediocre? Do you have a share class that I can sell into that's going to make a pretty good cash on cash return? So I think that yielding a couple of points on return in exchange for stability, God forbid, collateral, as a debt fund does that, but even stability on the multifamily or other asset class market is what's going to get you out there. And I think you should clearly point to differentiators, the more people that are out there trying to sell equity as if it's still 2021, like, hey, upside potential, 18% IRR, it's only 4% cash on cash first day, but we're going to make you 18, I swear, because we're going to refinance it next year and the whole thing, right? That I don't think that equation is going to work as well as, it's not going to appreciate very much. It's going to just cash flow early. And we're getting good debt. Security and good returns. Bottom lining it, Seth, is how you're going to sell today versus selling the dream.
I love that, man. This is great advice. Staying grounded here when you're raising capital and you're selling this deal. Matt, it's been awesome having you on the show. Where can our listeners find out more about you?
Go to DeRosaGroup.com, DEROSA Group.com, to learn more about, we have a passive investor portal there. If your listeners are considering passive investing, you can do that. You can also grab a ton of the free education stuff we've got out there, underwriting tools, market evaluation tools. We do have a very, very reasonably priced couple $100 education program. If you want to learn from us, you can do that too for a couple $100 one-time investment, or you can grab all the bunch of free stuff that should be for sale, but it's for free on my website too, DeRosaGroup.com.
All right, brother. Thanks so much. Appreciate you.
Thank you.
Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.